Okay, investors, every few years, Wall Street writes a research piece so provocative that everyone has to read it. This week, we got such a piece from James Hangalan of Citrini Research and Alap Shah. Here's a link to their very well-written, it's a thought piece. It's on Substack. Click on the link below. Their question, investors, AI continues exceeding expectations. Could that be very, very bearish for the overall economy? First off, this is not Oak Harvest's current view of the AI world and how it progresses through the economy, but this article has gotten so much attention with institutional investors, we wanted to share it with our followers. Please remember, Glean explicitly says that this was a scenario analysis and not their prediction of where abundant AI compute could lead the U.S. economy into a spiral of accelerated white-collar unemployment, higher mortgage debt default rates, increased consumer credit and credit card defaults, political pressures in D.C. to fix the problems, and potentially a recession in 2027 and 2028. So, with trading desks in New York thinly staffed for the blizzard, computers took over and markets reacted immediately Monday morning. Several stocks mentioned in this piece dropped more than 10% Monday morning. Let's walk through some of the piece. The whole thing is worth a read, if only to get you thinking. So, their core thesis is abundant intelligence from AI. The piece starts out in late 2026 when everything looks perfect. They've got the S&P 500 near 8,000, the NASDAQ near 30,000, unemployment is low, and AI investment accelerating throughout the year. So before I move on, investors, think of this. The S&P 500 at 8,000 is 16% higher than where we are right now. And the NASDAQ at 30,000 is over 31% higher. But guess what? This part of the author's piece wasn't focused on. When I saw even mentioned it, they all jumped right to the doom 2.5 years out, as if that were the forecast set in stone. So the core of the piece projects out 2.5 years and imagines the economy in June 2028. Out there, they have a scenario where unemployment hits 10.2%. The S&P 500 is down minus 38% from its October 2026 highs. As frequent followers of Oak Harvest content know, this is a recessionary move down in stocks. Early layoffs in the second half of 2026 supposedly boosted earnings and stocks rallied. Productivity surged like it did during the 1990s. However, wage growth peaked and then collapsed the next year in 2027. The owner of compute benefited, labor did not. The authors call this ghost GDP. Output appears in national data, but doesn't circulate through households. AI exceeded expectations. The financial markets rewarded AI. The U.S. economy didn't. So the authors postulated a negative feedback loop and labor spiral. AI improves, company cuts employees and workers spend less. Since we're over a 70% consumer economy here in the United States, margins compress, companies then invest more in AI to protect margins and lay off more people and workers. AI improves again, and this matter becomes a white-collar incomes as an anchor of $13 trillion U.S. housing and mortgage market. It all began with software. Looking back in time, this was supposedly started in late 2025 as agentic coding tools took a step function leap with software developers like Claude Code replicating software as a service models in weeks. Software companies faced pricing pressure after hiring thousands of developers post-COVID reopening back in 2020. When their customers initially cut staff, they canceled software seats. AI-driven efficiency at one company reduced revenue at another. So what happens out in the future when friction goes to zero, they postulated? Well, compute growing exponentially by early 2027, AI agents could optimize consumer decisions automatically, 24 hours a day, 7 days a week, 365 days a year. The median American consumes about 400,000 tokens per day currently. By then, they postulated it would grow tenfold in 1 year. So those AI computer agents could shop for insurance. They could cancel subscriptions. They could price match everyday purchases. They could squash commissions-based industries or route transactions almost for free. Computers and machines don't have brand loyalty. They just compute, optimize, and transact. Citrini hypothesized that in this business model built when friction compresses. Investors remember Jeff Bezos' famous quote from about 30 years ago. His quote, "Your margin is our sales." Imagine that exponentially. So But by 2027, white-collar job openings were collapsing, while white-collar workers represent about 50% of employment. Investors, they drive about 75% of discretionary spending here in the United States. Remember that in the U.S., the top 10% of earnings account for over 50% of all U.S. consumption. Investors, that's that K-shaped economy we've discussed in the past. So if white-collar workers lose jobs, can't find replacement jobs, have to take a 50% pay cut, economic spending falls disproportionately. They postulated in this scenario, by mid-2027, a recession with 2 negative consecutive GDP prints hits the economy. During so, credit exposure. Citrini goes into great discussion on private markets that have experienced massive growth in the last 10 years, as well as the potential for mortgage default contagion. Delinquencies would rise in high-tech zip codes because of structural income impairment. Investors, prime mortgages are less serviceable due to high white income job losses. That would be bad. The policy constraints in DC would be high. Because of layoffs and automation, labor share of GDP would fall from 56% to 46% in only 4 years. Remember, this is all just a scenario, worst case that they write about, not their forecast. But you know what? Robots don't pay taxes and they work 7 days a week, 365 days a year without benefits. And under that scenario, payroll taxes would decline, income tax rates would decline, productivity gains would accrue to capital, not labor or workers, so the federal government would have to step in while collecting less revenue. They call this the intelligence premium. Prior to AI, this massive compute boom, human intelligence was scarce. Now, with all this compute intelligence, machine intelligence has been substituted for basic human intelligence. Repricing the abundance of brain power is not collapsing, but it is a change and it could be painful. The key reminder, but the funny thing is, this was written this year in February 2026 with the S&P 500 only about 2% from all-time highs and a projection of 8,000 on the S&P 500 in the next 6 to 9 months that no one seemed to pay attention to. Investors, the negative feedback loop that Citrini postulates haven't begun. In fact, an interview done, Van Galen 2 days later said Citrini historically has been criticized for being too bullish. In fact, he said, and I quote, "We're definitely not allocated for a financial crisis." So investors, if you read this, just remember, most of these scenarios won't likely happen, but AI will continue to accelerate and change many businesses over the next 3 to 5 years, maybe even less. As investors, we still have time to access our financial plans, assess them, and assess our investment portfolios and make changes if we need to over the coming months or coming quarters. So investors, for now, 2026 has been a sloppy, choppy mess for the S&P 500. We are navigating slower growth, factor rotations, and higher base rate volatilities in the market. Oakharvest's guidance remains consistent. Stay disciplined, stay diversified, stay focused on long-term objectives. We continue monitoring these structural risks and positioning portfolios accordingly. Investors, whether your priority is growth, income, or a combination of both, our team is here to help you plan for your financial future, no matter where you're at in your career or in your retirement journey.